Across the United States, the housing market has been undergoing a slow but perceptible shift. Sellers are discounting list prices, active listings are finally up, and mortgage rates have inched back after weeks of decreases. But in the microcosm of Manhattan, a different story unfolds. The city that never sleeps has seen its residential property market moving sideways since 2017. Now, after a dramatic period of volatility, it appears to be coming back. The question is not just about a national market correction. The unique forces acting on New York City, from the 2017 tax changes to the seismic shock of a global pandemic, have created a property market defined by extremes.
For first-time home buyers nationally, or the global investor looking at an alpha plus city like Manhattan, the decision to buy is complex. The financial stakes are higher than ever, and timing the market remains a challenge. This is the story of two housing markets, the shifting landscape of the US and the resilient yet turbulent cycles of Manhattan. Tonight we examine the data, the conflicts, and the outlook for what could be the biggest financial decision of your life. To understand the current climate, we must first look back. Manhattan's residential property prices experienced a significant upcycle from 2011 to 2017. This 7-year run eventually ran its course, leading to a down cycle from 2017 through 2019.
This slowdown was initially driven by market reaction to decreased tax deductibility on primary residence property. It was compounded by increased mansion taxes, an oversupply in the 5 million plus high-end segment, and overall increased inventory. But in the first quarter of 2020, signs of recovery emerged with an increase in sales volume. That optimism was short-lived. By March 15, 2020, COVID-19 delivered an unprecedented blow to New York City. The real estate market was effectively locked down from mid-March to the end of June 2020. Uncertainty was at its highest. The rental market was hit hardest. With work-from-home policies in effect, many renters moved out of Manhattan, seizing a once-in-a-lifetime opportunity to work remotely and save on high city rents. Amidst the uncertainty and media chatter about the death of big cities, May to July 2020 marked the true bottom of the Manhattan market. As the market cautiously reopened in July 2020, new protocols and limited showings became the norm. But the recovery was already beginning. While Manhattan wrestled with its post-pandemic recovery, the national U.S. housing market has been dealing with its own forces leading into the 2025 market. According to the Realtor.com August 2025 Housing Market Trends Report, there are positive signs of improvement and indications that the national real estate market has become more balanced. A key factor in this balancing act is inventory. Nationally, the supply of houses for sale has been growing, exceeding 1 million active listings for 4 straight months. This growth has been happening for 22 months.
This increase in choice for buyers is coupled with a noticeable increase in the time homes are staying on the market. The median number of days homes were on the market rose to 60 days in August. That's 7 days longer than the same time last year and above pre-pandemic norms for the second month in a row. This longer time on the market is likely a direct trigger for seller discounts. Indeed, in August, more than 20% of listings nationally featured price reductions, with the biggest cuts occurring in the South and the West.
The biggest shadow cast over the national market is the persistent issue of mortgage rates. The 30-year mortgage rate over the past year slipped to a low of 6.08% in late September 2024, but has not returned to that low watermark. The highest rate over the same period was 7.04%, according to Freddie Mac.
While rates have been on a mostly lower trend since the end of May, they have recently started increasing again after the Federal Reserve's September 17th meeting. For a potential buyer, especially a first-timer, navigating these rates is critical. It's a competitive process where shopping around is key. Zillow research indicates that 45% of first-time homebuyers who shopped multiple mortgage lenders secured a better rate. Crucially, a larger down payment can also earn a better mortgage rate. Lenders rely heavily on credit scores to qualify applicants. The median credit score on a new mortgage in the second quarter of 2024 was 772.
While a conventional mortgage generally requires a FICO score of 620 or better, and FHA loans can go as low as 580, the higher the score, the better the loan terms offered. A higher score can translate directly to a lower annual percentage rate over the life of the loan. While exceptions can allow for DTIs up to 50%, this ratio is calculated by dividing total recurring monthly debt, including mortgage payments, car payments, and minimum credit card dues, by gross monthly income. Notably excluded from this calculation are utilities, car insurance, streaming subscriptions, and health insurance costs. Back in Manhattan, the 2021 recovery was dramatic. Fueled by low mortgage rates and pent-up demand, the city experienced a surge in sales volume, with 2021 ending up with the highest sales volume ever recorded.
Inflation peaked at 9.1% in June 2022. The Fed's actions drove 30-year fixed mortgage rates to 6 to 7%, more than doubling the rate seen in early 2022. Because 50% of Manhattan buyers need mortgage financing, this made purchasing a property significantly more expensive. Many potential buyers became renters. The immediate result of the rate hikes was a slowdown in sales volume during the second half of 2022. The market, defined by strong demand in 2021, shifted. From mid-2022 through 2023, Manhattan found itself in a buyer's market. Since 2024, it has been primarily moving sideways, which has continued into the present, largely due to those persistently high mortgage rates. Yet, despite the high-rate environment, the market is showing resilience. Key data from the second quarter of 2025 reveals a complex picture. The average price for a Manhattan condominium reached $2.938 million, a 3.1% increase from the prior year. The price per square foot was $2,045, up 3.2%. Crucially, the number of transactions increased by a robust 23.2%. This surge in sales activity is happening even while mortgage rates remain high. Months of supply, a measure of how long it would take for all current inventory to sell, decreased by 14.8% to 9.2 months. This suggests that the market, currently assessed as neutral, may be heading towards an upward price trend again. Adding to the stability are soaring rents. As those who moved out during the pandemic were required to return to the office, they drove up the rental market. In June 2022, the average Manhattan rent surpassed $5,000 for the first time. By May 2025, it was at $5,379, with the rental price per square foot up 8.9% compared to the prior year. For investors, this is translated into record rental yields, with some properties increasing rents by 40 to 70% relative to pandemic-era lows. While Manhattan grapples with pricing cycles, the U.S. national market faces an endemic shortage. Even with new home construction growing and 1.63 million homes added to the inventory in 2024, the U.S. housing shortage remains at an all-time high of 4.7 million units. Orphy Devungi, senior economist at Zillow, noted that while construction has helped prevent the deficit from ballooning, it has not yet begun to close the gap. New home sales nationally increased by 4% in August compared to a year ago. Realtor.com expects 1.1 million new homes to be built this year, nearly a 14% increase over 2024. Builders are now focusing on smaller, more affordable houses, a sign they are responding to buyer demand for lower price points. This makes new construction an active option for current buyers. The central conflict for any potential buyer is market timing. Many potential buyers ponder whether they should wait for a recession. Mortgage rates. However, this creates a secondary problem. Lower rates generally increase buyer demand, which would likely cause house prices to rise.
Buying a house when both mortgage rates and home prices are favorable is a profound challenge. Experts advise against trying to time the housing market by waiting for a recession. The alternative argument from buy now advocates is to purchase the home when financially set and then look to refinance later if rates drop. But this strategy carries risk. What if rates don't drop substantially enough to justify the cost of a refinance in a few years? The core advice remains to only buy when comfortable with the terms on closing day.
The decision is less about market timing and more about evaluating one's personal financial situation. For the global investor, Manhattan property remains an essential asset. It is deemed, along with London, one of the world's top 2 Alpha++ cities for price stability and asset diversification. Key reasons high net worth individuals globally invest here include stable price increases, low credit risk, tax breaks like depreciation, and asset diversification. The price per square foot trend for Manhattan condos shows stable appreciation in the long run. While it dips during recessions, the market always recovers. The Q2 2025 price per square foot of $2,045 is nearly at the 2017 peak, suggesting the current high-rate environment has not stalled long-term value. This is especially true for cash buyers. The high mortgage rates largely impact buyers needing financing. For a cash buyer, this neutral market presents a prime time to purchase and rent out the property. With inflation decreasing to 2.67% as of June 2025, and the expectation of future mortgage rate decreases, the outlook is positive. Whether it's a smart time to buy is a fundamentally personal calculation. The decision is a medium to long-term investment that requires a comprehensive look at personal and financial factors. Beyond the down payment and closing costs, buyers must account for property taxes, financing fees, and moving expenses. Experts advise a primary consideration be the stability of one's income and whether the job is secure or requires a location change soon. The commitment also requires a long timeline, bringing friends, family, and community amenities into play. A buyer must comfortably afford the monthly mortgage payment and expect to stay in the home long enough to offset the significant money paid up front. Only then is it a smart time to buy a home. A large chunk of a buyer's savings must be dedicated to the down payment. This cash cushion also serves to show lenders' preparedness for the unexpected. For a conventional loan targeting first-time home buyers, a minimum of 3% down is required. However, the ideal down payment is 20% to avoid private mortgage insurance. Zero down options do exist for those eligible for VA or USDA-backed loans. According to Realtor.com, the median down payment in the fourth quarter of 2024 was 14.4%. The question remains whether life in Manhattan has truly returned to normal. Subway ridership is back to normal,
Tourists are back, and restaurants are busier than ever. The only visible signs of the pandemic are vacated storefronts and less occupied office buildings. True normalcy, some argue, will come when all the shut-down storefronts are occupied again. Finally, for buyers, the issue of locking in a mortgage rate is a short-term tactical decision, generally lasting 30 to 60 days or sometimes up to 6 months.
The advice is straightforward. Be comfortable with the rate on the loan estimate and proceed. There's little reason to over-agonize the decision. The outlook for both the national market and the Manhattan market is defined by the tension between high rates and improving inventory. For buyers, the key takeaway is the power of shopping and negotiation. More than half of home loan borrowers, 56%, only get a pre-approval from a single lender. This dramatically reduces bargaining power and limits the opportunity to find a better interest rate from a business-hungry lender.
First-time buyers, according to Zillow, are more likely to reach out to at least 3 lenders and 3 real estate agents than repeat buyers. This relentless shopping is the recommended strategy. In Manhattan, the optimism is building. After 8 years of moving sideways or down, the confluence of record-high rents, a neutral market assessment, and a substantial 23% increase in transactions, even with high rates, signals an upward price trend. This is supported by positive macroeconomic factors, including the stock market at record levels and expectations of reduced regulation in finance and banking. On the national front, the long-term outlook for affordability is tied to personal income and savings growth.
Buying that first house is often a stretch, with the monthly payment looming large. However, as years pass, the payment becomes less of an issue. Ultimately, as home prices continue to rise, the homeowner is placed on the right side of the equation. The growing home equity is what builds net worth over time. For those ready to move, there are clear, immediate steps to take. First, use a mortgage calculator to determine the affordable monthly payment. This dictates the necessary home price, down payment, and mortgage interest rate needed to meet the home buying goal.
Second, if the desired area is too pricey, consider expanding the search to more affordable areas close to the favorite neighborhood. Third, consider new construction homes, especially as builders focus on affordability. Buyers may be able to choose finishes or negotiate a better deal on an already completed spec home. The final, most crucial step is to get a written pre-approval from a lender, and only then shop for a house that is both loved and affordable. The U.S. housing market is offering a mixed bag of pros and cons. High mortgage rates are balanced by improving inventory and increased time on